I was going to ask how many of you are actually against free market, but after having heard a bit of a previous discussion, I think I won't ask you that. But I thought this morning about reversing totally the presentation I was to give you, and also because I've seen that you can read my ideas on the current crisis in the paper that were distributed, and actually expose myself to you tonight by trying to explain you and show you and demonstrate you how and why the free financial markets have failed. So you have various slides which explains you the current crisis. I'm sorry you don't have one, but see what I have. This is a graph that tries to give an idea of what the balance sheet of the world most important banks looks like right now. On one axis you have a leverage, so basically just total assets divided into equity. And you see that you have banks that are very leveraged, like Deutsche Bank, and banks that are less leveraged, like Wells Fargo, on the other end of the spectrum, or Bank of New York Mellon at the bottom. On the bottom axis, you have the riskiness of the assets that the banks own. And all the data that I'm giving you is straight out of a bank balance sheet as of last June. And to give you an idea of what riskiness means, I will use the standard Basel II criteria. And the standard Basel II criteria assign a 25 weight to AAA bonds. So if a portfolio, 100% of AAA bonds would basically reside on the 25% point here. If you are at 70, it means that your portfolio is equivalent to a portfolio that is half BBB bonds and half single A bonds. If you own only equities, your risk ratio would be 125%, so beyond this axis. And if you own only hedge funds, it's actually weighted 250, so way beyond this axis. So what these axes show you is that all the banks of the world face a trade-off on how much they want to leverage and on how risky the assets they want to leverage are. Deutsche Bank, as you see, is very highly leveraged, 60 times almost, but on low risky assets. On the other end of the spectrum, Wells Fargo is far less leveraged, only something like 14 times, but on more risky assets. This is what we all know, because it's public information. We also know the red line. The top red line is basically the minimum capital requirement according to Basel II criteria. And we also know that some of the banks have had problems and have had to be bailed out. And you see the red dots are the banks that had to be bailed out. And you see that they're also pretty much randomly distributed, because the problems that they had were not on the asset side, were on the funding side. The banks that did not have access to stable funding had to be rescued. But we need to understand this crisis, we have to understand better what the asset side of a balance sheet is. Because what we know is that the banks have been regulated into this sort of position. Banks must have at a minimum Basel II weights, and usually authorities allow them to be between 1 and 2 times the Basel II criteria, and as you see, they all fit into that band. I have tried to give you a more physical idea of what a bank balance sheet looks like now by focusing on the two extremes on this graph, Wachovia and Deutsche Bank. And you see this on the next slide, where let's start with Wells Fargo, that is somewhat easier. These are simulated portfolio using standard Basel II criteria. So this is an optimistic view of the risk they run on the portfolio. It is optimistic because banks are allowed to use their own internal model that are more generous, so are allowed on the same leverage to actually have more risk on their assets than what we will show you here. Wells Fargo portfolio is, in terms of risk, according to Basel, considered identical to carry over 7 times leverage in equity and 5 times leverage in AAA bonds. for a total assets of 12.7, meaning it is leveraged 12.7, and if you use the Basel II standard coefficient where equity are weighted 125% and AAA bonds are weighted 25%, you get to risk-weighted assets of roughly 1,000, which give you the risk-weighted to total asset of 0.85. I am a banker. I would not sleep at night with 7 times leverage in equity plus 5 times leverage in bonds. If you take the balance sheet at the other extreme, the one of Deutsche Bank is 60 times leverage, as you see from the total assets, and the riskiness they claim to have in those assets is equivalent to carrying 36 times leverage in AAA bonds and 24 times leverage in T-bills. Now we know that they must have more risk than that into their balance sheet, because a balance sheet with this structure would provide no income. You wouldn't have the financing spread that you need to make a profit as a bank. So it is obvious that by using the benefit of correlation, which I have not used here, they have a portfolio which is actually more risky than the one that I reconstructed here. But even that, with 36 times leverage in AAA bonds, I would not sleep at night. Now maybe it's better to understand what leverage means. I mean, you should all, I think, more or less be economists, but I mean, if you are 10 times leverage and you lose 10% of assets, your history. If you are 20 times leverage, suffice that you lose 5% of your assets. If you are 50 times leverage, with a 2% loss on your assets wipes out your equity. Deutsche Bank is 60 times leverage. Now, why are we in this situation? We are in this situation because basically over the last 50 years, the banking world went from a standard business of deposit taking and lending. It migrated into more of a securities business. But the regulators were still regulators from the banking world, so they did not have a clue of the kind of risk that security business implies. And to give you a demonstration of that, I have reconstructed the portfolio of a hedge fund. I know hedge fund very well, and I have tried to imagine the riskiest portfolio that I've seen over the years from hedge funds, and calculate the ratios of that. And the riskiest portfolio I've seen in hedge funds would be equivalent to roughly 3 times leverage in equity plus 1 time leverage in bonds, which would give a leverage of 4 and a risk weighted to total assets of 0.7. So if I go back, look where the hedge fund sits. It's way more prudent than most of these banks. I also run a bank. My bank has a risk weighted to total assets of 0.7, 70%, but is only leveraged 1.6 times. I admit that I run the bank probably too conservatively, but I would not sleep at night with more than 3 times leverage with 0.7 risk weighted to total assets. I think that would be totally irresponsible. So the problem that we have today in the financial system is that the banks are probably between 2 and 3 times too leveraged for the sort of risk that they are running, which explains you why a plan like the one the US has passed last night, which basically targets a decrease in the assets, is probably not going to be very effective, because what the banks need right now is capital, and probably nothing short of massive nationalization will put an end to this mess. Now, why did we...